objective 3 is going to be about applying horizontal analysis, trend analysis, and vertical analysis. We're going to hold off. We're going to do one more section of notes and then we're going to do it. Sorry.
Yeah, you gave us double too.
Oh, learning objective 3. We're going to apply horizontal analysis, trend analysis, and vertical analysis, and look at some ratio analysis using financial statements. So, the most common tools and techniques in financial analysis are these 4 techniques that we're going to talk about: horizontal, trend, vertical, and ratio analysis. First, we have horizontal analysis. And horizontal analysis begins with a computation for change from last year to this year. And when we're doing horizontal analysis, we're going to look at it in terms of both dollars as well as percentages. And the base year is the first year that is being considered in any particular set of data. So if you were comparing 2011 to 2012, your base year would be 2011, okay, the first year. Okay, so you're looking at the dollar change and the percentage change. And if you would, turn to, I just want you guys to look at this. Turn to, in your textbook, page 6. 595, if you would. Look on page 595 in your textbook. So this should look somewhat familiar to you because it's a little bit like what you kind of did when you did your income statement analysis project, where you were looking at 2 years worth of data and then you were doing the change in dollars and change in percentages, okay? So that's essentially what we're doing when we do horizontal analysis. And what you want to look at here is, let's look at the balance sheet for Starbucks company. And what we can see is, if we look down the percentage column, what is the most significant percentage change in their assets? What is it? Alex, go ahead, tell me.
No, I wasn't listening. Sorry, I was distracted. I'm back now.
What is the most significant percentage change? Cash and equivalents. Good, thank you. It's 122% change. So their cash went from 2008 to 2009 from $269 to $599. And in terms of dollars, $330. So clearly that's very significant. It's significant in terms of percentage, and it's significant in terms of dollars. But if you look at the percentage change for, let's say, short-term investments, that percentage change is still pretty significant at 26%. However, when you look at the dollars change, it's not very significant. It's only $13.8 million. Relatively speaking, compared to $330 million, 13 is not significant, okay? So you got to look at both, okay? Because while 26% seems really, really big, you also have to look at the dollars that are being addressed as well. Okay, then let's look at our second technique, trend analysis. Trend analysis is a little variation on the horizontal analysis, but we're going to do this for some consecutive or successive years, beyond just 2 years. And then the trend analysis uses what we call an index number to show the change in relation to that index number over years. So typically speaking, our index is our base year, and we go from there. So again, if you look in your textbook and by way of comparison, look at page 597. And if we look on page 597, we look at the table for Starbucks, we see a little trend analysis of their both their revenues and their operating income from 2005 to 2009. And we can look at it in terms of dollars, and we see in each year revenues are going up, correct? And also operating income is going up for 3 years, but then it starts to go down, right? So that would be in dollars a bad trend, okay? Then we look at the trend analysis in percentages, and it gives us a better picture of what's happening with that trend. We see the net revenues consistently going up. So over the period of time from 2005 to 2009, we see that it's gone up 153%. However, we see a bad trend in their operating income. So that means for every dollar of sales, they're generating less profit. Okay, so we see that it goes up 2005, 6, 7, but then 8 and 9, it's going down. So that's a bad trend, and that's the types of things you want to understand. Why are their sales going up, but their profits are going down? So what are they doing wrong, arguably? Okay, and in this case with Starbucks, what they were doing wrong is they were opening up a lot of stores. Remember I told you about that same store sales issue? Okay, you got to evaluate when we're dealing with retail. You want to evaluate same store sales. So some of their sales were going up, but because they were opening new stores. But because they were opening new stores, they had maybe a lot of operating costs that were going up as they were opening those new stores. Maybe those new stores were not as profitable. So they opened a store in a market, but maybe that market was saturated and they didn't need that store in that market. So that store, on a dollar for dollar basis, wasn't continuing to generate as much profit as it needed to. So what they ended up starting to do, and maybe whoever's got Starbucks can, see where they stand today, they started to have to close some of the stores that they opened. Okay. Okay, next one. Vertical analysis. This you guys have done before. This is your component percentage analysis, your common size analysis. It shows how each component of the financial statements relates to the total. And it's used to help us compare relative importance of different line items in the financial statements. So when we take a common size and common size information, we could break it down. And what do we see for the graphic here is we can see what percentage of assets are the most significant percentage of assets for a company in any given particular year. Okay, just look at it up here. Okay, so what do we see? What's the most significant percentage of assets in 2009 for this company? Property, plant, and equipment, okay? And then current assets were the second most significant percentage. And then we can look at it and we can see how their assets shifted between 2008 and 2009. So in 2008, it was still the most significant percentage, but then it declined from 52% to 45%, a fairly significant decline. But we can also see that while this declined, what increased? Their current assets. So they shifted more of their focus of their assets from fixed assets to current assets. So they might be, I don't know, they could be selling more stuff, okay? They're amortizing the goodwill over time. So it should, unless they buy another company, it should start to go down over time. The significance of the goodwill compared to when the company was first acquired goes down over time. Because now you own that business and it's your own value, okay? So remember, goodwill is the markup in the price of a company that you buy, okay? All right. So this is how we would look at a common size analysis. We would look at the percentages, the component percentages of each of these items. And this is just taking those numbers that were on the graphic and putting them into a common size, spreadsheet. And then this is the common size income statement. Again, just taking a graphic depiction and changing it from the spreadsheet to the graphic. Okay? So for those of you who would like to learn some more sophisticated Excel spreadsheet techniques, I can show you how to create these types of graphs from your income statement spreadsheet, for your percentages of your common size, if you wanted to if you were so inclined to include those in your financial projects for the end of the year. That's a really good thing to know when you go into college. It's useful. Okay, so lastly, financial ratio analysis. You guys have this, right? This is where we use analysis to help identify key relationships between components of the financial statements. We use these tools to evaluate a company's financial position and their operations, and it may actually reveal areas that need further investigation. Okay, we're not going to do this stop and apply problem though.